on a global front, but I think this technical factor of beneficial ownership disclosure has set the cat amongst the pigeons, So technically, you have some levels to defend in the markets per se. And, broader markets and some segments of the market have seen a stupendous run-up. So you name some of them, the railway stocks, the defense stock. I would just call it a technical sort of a profit booking. Underowned spaces will likely outperform, and these could be in the form of your technology or pharma or, some of the lesser known banks, so on and so forth. But I would call it just normal profit.
Okay, just normal profit booking. Got that. The stock of the moment, though, is Pidilite. It's up about 5% odd. Very strong numbers, as our colleague was telling us earlier, right? Volume growth of 10%. This morning, JP Morgan has upgraded Pidilite to an overweight. They've raised their target price to 2,900, which is a big upside to the current market price. Manish, how are you feeling about the consumption space now? I mean, we have very mixed numbers here, depending on which part of the basket you look at. But overall, do you think that this could be a space that comes back in 2024?
Consumer discretionary will likely come back in a big way, somewhat pre-elections and more of it post-elections. Not so bullish on the consumer staple space because valuations vis-a-vis earnings growth doesn't seem to be in sync. But some of the numbers that have come out of Pidilite or United Spirits seem to suggest that probably we are in an upcycle as far as the earnings trajectory on some of the consumer discretionary names would be there. So more bullish on consumer discretionary than staples.
Okay. All right. Hi, Manish. Good morning and good to see you in. Nigel on this side. What about the banking names? We got into 2024 saying that the consensus was buy banks and banks will do well. Now, post some of these numbers, some of these stocks have corrected big time. What's your preference from the banking space, and are you bullish on it?
See, if the earning numbers on FY25 and 26 have to come, banks really have to be contributing a large part of it. And there's no doing away from that because, they would contribute roughly around 1/3 of the total earnings growth of around 16% that we build in for FY25. Now, the stock price direction seems to suggest that either the markets are wrong about the earnings growth or there's significant P-derating that is happening across the index heavyweights, that are there in the banks that contribute in the index. So the likes of an HDFC, ICICI, Access, Kotak, so on and so forth. I think these could be on account of the beneficial ownership disclosures that, some of the foreign owned entities might be forced to sell. But clearly there's value on the table. I mean, as the P-derating continues to happen, this basket or this space continues to remain a clear value buy, so to speak. Really don't know when the whole P-derating story gets over, but either the total earnings trajectory on the index, Nifty, will not come at 16-18% if the banks don't contribute, or the P-derating is somewhere closer to where we should be. Can't get derated too much from where we are today. So I would say that clearly it's a value buy, but the whole problem is that some of these known banks are massively owned by the domestic institution. Perhaps a full allocation that is allowed. So mutual funds allow 10% on individual stocks on ICICI Bank. Every mutual fund will file 10% allocation. Similarly with HDFC Bank. So the leeway for fresh buying in some of these banks by domestic institutions doesn't seem to be. I mean, broadly, ballpark, maximum allocation. So it continues to remain a value buy, but that is how it is. Unless and until you see participation from the retail or the foreign institution, they continue to be laggards. But there is definitely value on the table in some of these names. I think the preference for, PSU banks is clearly out there. These are underowned, and as far as the tailwind for the entire banking space is concerned, it's even for them, some of the numbers are very good, and the P multiples, etc., the valuations are, very, very palatable, so to speak. So greater value in PSU banks than private sector banks, and technically speaking, also, not so much of an overhang of over ownership. So continue to remain have preference for PSU banks.
Manish, on a lighter note, if you want private banks to do well, get retail excited. Because, foreigners, as you said, already all own it. and they've not been able to push them higher. But you get.
But then actually, domestic institutions own it full. There's not so much of, I don't know, foreigners might be forced to sell because of disclosure. That 2.5 lakh crores worth of AUM that you require fresh disclosures. And I'm sure banking would be a major portion of their holdings since, in the benchmark at one point in time, they were close to 40% of the total weightage to a Nifty would have come from the banks. So perhaps the buying would have to come from the foreign side in some of the private sector banks because there's definitely value out there.
Yeah, Manish, since you brought up this FPI issue, have you been able to have you spoken with any of the foreign fund managers? Because I spoke to a few, they've said it's a real issue and they'll have to deal with it. But there are ways around it. So, for example, one of the criteria is that if you have over $3 billion of investments in India, right? That's a minimum. Then you have to disclose, which is 25,000 crore figure number. And most of this is going to impact people who come through via P-notes. Now, people who provide you P-notes, I mean, let's just assume an example. If there is entity X, a large bank which offers P-notes to investors, and it is full up, it's got investments over $3 billion, and there's another one which is, say, at $1 billion or $1.5 billion, that can go up to $1.5 billion, right? So, the second entity goes up to the clients of the first one and says, well, you come through via us. So there are various ways around it, and there's 6 months' time. So would you agree with it? And any feedback you got, Manish?
Absolutely. If you see some of the recent, block deals that have happened in the market, some of the P-notes have exchanged hands. So obviously what you're saying is actually happening in the market. And obviously if a foreign institution has to get some exposure into India and India can't be ignored for too long, you would have to find ways around it. And as far as my discussion with a few of them, I don't seem to, sense any major sense of panic as far as these regulations are concerned. And the regulations are there. I mean, look at it this way. If there was a selling that would have come from the FIIs, we saw massive selling even during the COVID days. But it didn't really set off a panic. So whether the Indian markets are expensive or not is the key question. And at this given point in time, they are not grossly over expensive. You may call them not very cheap, but not grossly over expensive. And India remains a bright spot in the whole global growth story. So I think there'll be ways around how to deal with this. But if there are new disclosure requirements from the regulators, one has to adhere to it. And how they are going to go about it, $3 billion, somebody has 1.5, additional 1.5. You'll see all sorts of P-note transactions via block deals that would happen in the market. I think that's the logical way that I see it. But I don't see any major sense of panic within institutional investors on the foreign side.
Okay. Manish, I wanted to come back to that point you were making about banks, right? Where you said that banks are a value buy at this point and you prefer PSUs. But what do HDFC Bank investors do? I mean, that seems like a value stock now. It's at a 52-week low as we speak. How are you feeling about that bank and what's the outlook?
Forget about the near term. If there was value at 1600, it becomes deeper value at 1400 and even bigger, deeper value at 1300, but it remains a value. So I think, it's the best owned, best managed private sector bank, a very large private sector bank, and the valuations just keep on getting better. So, I would believe that, leave aside the recent underperformance that you've seen in the bank, but it clearly remains a buy.
Okay, it clearly remains a buy. That's interesting. I mean, of course, you buy when the market is fearful, right? So that point is taken. What about pharma? Because, there is this increasing narrative that this year pharma will come back in a big way. The pricing pressures have gone down and stocks like Lupin are sitting at 52-week highs already. Are you interested to put more money to work here?
Absolutely an overweight position on the pharma space, clearly sector rotation. Pharma is one of them. And obviously, you've seen the numbers that have come out from some of these Ciplas of the world. And, you'll have Newlands and Alchems and Ipcas of the world also report good numbers. So I don't think that, valuations really capture the upside potential that is there in the pharma space. And if the earnings growth trajectory comes through, then there should be some PE re-rating also. So clearly an overweight position on pharma as far as I'm concerned. So, and that goes true even for the IT space.
All right. Manish, thank you very much for that.